Good. So to avoid too much long, awkward silence here, we'll go ahead and get started with the presentation. But we'd like to thank everyone for joining us today as we kick off the Raccoon Group's a trip around the world. What we're planning on doing is we're planning on highlighting various regions around the world through a multi-part series where we bring in experts on certain regions where they can come in and talk to us. And today we're starting with a very special presentation on Asia and emerging markets. And we're joined today by Charlie Wilson, who works with Thornburg Investment Management, also a Santa Fe firm. So we're always happy to have someone local. Well, Charlie's not local anymore, but the Thornburg is local to Santa Fe. So we really appreciate having him here. And we're trying to make this as interactive as possible. So any questions that come up, please feel free to send them along. You can email info@raccoongroup.com, or you can call and reach out to any of the team members with your specific questions. They will forward those on to us. But there'll be a short presentation, and we'll follow that with a discussion and kind of get into the topic a little bit further. So with that, I'll pass it to you, Charlie, to introduce yourself and Thornburg a little bit more.
Great. Thank you. Thank you for the time, and thanks everyone for joining the webcast. Yeah, so I've been with Thornburg for about a little more than 10 years and been focused on emerging markets for Thornburg since 2015. For those that don't know, Thornburg's been around for a little over 40 years at this point. It was founded in the early 80s by Garrett Thornburg, who probably was, I would say, a pioneer in the work remotely, the work remotely story, and the fact that he realized he could run an asset management firm from just about anywhere in the country, and decided Santa Fe felt a lot better to him than New York. So he had the vision to start the firm in the early 80s, and then we've grown it to 40 billion today. About half of that is in a little more than half of that is in fixed income, and the rest being in global equities. And so I think our primary focus on the equity side is really international markets. And so I think that was part of the the thought process today, is I could share a little bit about our thoughts on Asia and China and where that sits within the emerging market opportunity today. So maybe with that, I'll go ahead and share my screen. And
Great.
let me just make sure. Is that working properly for everyone?
It is. So we have your, there you go.
Okay, great. So maybe just jumping right in, my hope today is really to convince you that although emerging markets and particularly China have been bumpy in terms of an investment prospect over the last couple of years, that the investment case really has evolved, and there's really it's really worth taking a second look right now. So before I jump into looking forward, I'm going to talk a little bit about what's happened over the last couple of decades in emerging markets, and really trying to point out that emerging markets haven't been a significant source of underperformance in prior periods of volatility. So maybe looking back at major events in global equity markets in the early 90s, you had the Gulf War and the war in Yugoslavia. What we're showing in each period is you had the dark blue bar is the US index, the light blue bar is emerging markets, and the orange is the EFA index. And probably the most important, for this conversation are the last three periods. In that period 2002 to 2007, it was a period where emerging markets significantly outperformed both the US and EFA, other developed markets. And a major driver for that was the rise of China and their move to become a major global exporter. Going to the next period during the global financial crisis, it might surprise many of you, but through the entire crisis, emerging markets actually outperformed. And a big reason for that, again, was China. And so the importance of China being able to pivot their growth model and really move into a pro-growth mode very quickly, while the rest of the world was frankly scrambling to try to figure out how to stimulate during that period. And then more recently, COVID was a real standout in terms of challenges for the global economy, But emerging markets were also able to navigate that period in an okay fashion, despite not having the flexibility either from a central bank perspective or fiscal flexibility to support their economies. And again, a big reason for this is North Asia, so China, Korea, Taiwan, really being aggressive in how they manage the virus and getting back to normal faster. I think this really demonstrates how, emerging markets have gone from being, an area where they were really on the fringe of global equity markets to something that can really change the outcome for a significant part of global equity markets, with the strength of their, I'd say, their internal growth dynamics, as well as some of their the institutions that they've developed over the last couple of decades. Speaking specifically about China, this is a market that's I think really been a dynamic place to invest really for more than 2 decades, and a big driver for that is the rapid GDP growth we've seen during that period. So, since the late 90s, we've gone from around 1 trillion in GDP to around 16 trillion today. As I mentioned in the last slide, really the main driver for that was China's move into the WTO in the early 2000s, which really led to this shift towards an export-driven economy. They had actually, prior to that, been primarily driven by consumption. So, China does have the ability to be a growth-oriented economy driven by consumption, but for the last decade and a half or so, it's really been about infrastructure investment and growth driven by exports. And that was a model that really helped not only China but all of Asia and most of our emerging markets. But when you hit the global financial crisis and then China aggressively stimulated to get their economy going again, I think it really showed that there were some excesses that were built up in that economy, and they really needed to pivot away from that. And so the bulk of the last decade has been trying to step back from the fixed asset investment, infrastructure heavy, export driven growth model, and trying to move away from that. Well, that's also led to many people that maybe had a more negative view of China to predict, China's pending collapse. There's a couple of examples we call out, Kyle Bass and Jim Chanos. And they did have reasons to believe that it could be challenging. China has dealt with property market issues for most of the last decade. They've faced several challenges in their banking sector. They've had the trade war with the U.S. and then more recently dealing with the pandemic. Another thing that's also been a challenge has really been the shift away from the export-driven growth model, as I mentioned. When China entered the WTO in the 2000s, they saw a rapid increase in net exports. So this chart shows net exports for emerging markets in the dark line there, and then in orange specifically for China. And you can see they went from near zero in the late 90s to several $100 billion. And the primary driver for that was really China during that period. Global trade was averaging 7%. So it was a good time for everybody. Anyone was tied to trade was doing very well. But since the financial crisis, global trade has slowed down substantially. And over the last decade, you've seen in the orange and the dark line, you've seen net exports trend close to zero. So the tailwind from global exports really hasn't been there for some time, and has actually, frankly, been a headwind from a GDP growth perspective. And that's something that China's really been grappling with. And so I think it's forced them to rethink of how do we grow going forward, especially given some of the larger demographic challenges they're facing. And that's where I think this is, what's most interesting about emerging markets today is really this rise of the middle class, which has been, I think, underappreciated because unfortunately, or however you want to describe it, emerging market managers have been talking about the consumer in emerging markets for quite some time, but frankly, there hasn't been enough money in enough people's pockets to really be an independent growth driver that could take the handoff from fixed asset investment and global trade. So what this chart shows is the middle class in different parts of the world. The Middle East and Africa on the far left in the dark bar, the light bar is China, the green bar is North America and Europe, and orange is other parts of Asia and Latin America. And you can see between 2009 and 2020, you saw really rapid growth in the middle class consumer in China. And then the same for the orange bar, where you saw other parts of Asia, and that's primarily parts of Asia like India and Indonesia that have seen a rapid growth in their middle income consumer as well. That's an important shift. At the same time, the green bar has basically stayed the same. So developed market middle income consumer is really not grown at all, but you're seeing this rapid growth out of the middle class and EM. If you look forward to 2030, it becomes even more pronounced, and it really shifts away from China towards other parts of emerging markets, other parts of Asia. So just to put this in perspective, from 2009, you had about 700 or 800 million people in the emerging market middle class. By 2020, you had close to 2 billion people, and by 2030, it's expected to be close to 4 billion people. And I would argue that's a demographic trend that's very strong and can lead to significant, positive tailwinds. The other thing that's happened, is the fact that I mentioned this earlier, but central banks in emerging markets have really done their part to try to become, really strong global institutions, and that's important because during periods of rising U.S. interest rates or dollar strength in the past, that would have been significant currency volatility, which would have led to instability in many of these countries. If you look on the left side, what we show here is the EM weighted policy rate in dark blue, the dark blue line. The dotted line is the inflation rate, and the orange lines represent the same but for developed markets. And you can see early on in this period where we started to have higher levels of inflation, emerging markets were quick to raise interest rates. They knew the Fed was planning to raise interest rates. They knew they had to be in front of that. They also knew that they needed to maintain reasonable levels of inflation, so they had to stay on top of that. And I think that the outcome of that is that on the right side, real rates have been positive throughout most of this period over the last couple of years, while for emerging markets, while real rates in developed markets have gone strongly negative in many cases. And that's actually led to relative currency stability for emerging markets, which I think then helps to anchor inflation expectations and also allows them to have lower interest rates in the longer term. So why is this important? Why do we care about this setup? I mean, it's great to talk about a rising middle class, but I think the more important thing from us is, what does this mean from an equity investor's perspective? We use the U.S. analogy, which is, I think, undergone a similar type of transition over the last 40 years as a proxy for what we might expect in emerging markets. On the left side, we show the percentage of the middle class within the U.S. population going from the low 50s to the mid 60s over the period from 1980 to 2020. I think in the middle, many of you probably remember periods where inflation was very high in the early 80s, and our policy rates were also very high. But as we were able to contain and re-anchor inflation expectations, our policy rate has fallen and continued to remain low, perhaps too low in the last couple of years. Over the last, which is I think enabled equity markets to take off. On the right side, we showed the S&P in the dark blue line there, and the PE valuation on the S&P, which has gone from 10 to more than 20 times during the 2020 period. It's hard to say that things will progress quite that linearly, but when you put falling inflation, lower interest rates, and a rising middle class all together, it's a pretty powerful combination, which could really drive equity performance. Just to maybe put one last point on this population dynamics. On the left side in the dark blue, we showed the percentage global population in emerging markets, and that's been hovering in the 84, 85, 86% range. And it's expected to stay there. So we've known there's a lot of people in emerging markets for a long time. But again, like I said, the bigger point is in the diamond, in the yellow diamond, we show the percentage of the global middle class that resides there. And that's increasing substantially from 12 to close to 51% over the next decade. and that's really going to be the important driver. And what we've also seen in the middle is that GDP growth has continued to expand. So the amount of GDP coming from emerging markets in the dark blue has also started become close to where we are in developed markets today. But that's also expected to continue to grow. And so I think the big question mark is the one on the right. A little less than a third of global market cap is in emerging markets today. But if you have more than half of the of middle class consumers and more than half of global GDP, and you have the tailwind of middle class consumer growth, it does make sense that more and more of the market cap should also shift to emerging markets. Final piece, and then I'll open it up for questions, is how EM indexes have evolved in general. And I think today what we show here is on the dark blue lines is 2012 was the composition of sectors for the EM universe, and the light blue lines are the composition in 2022. The circles represent the world index. And so the point we're trying to make with this slide is that you've seen a shift in the composition of the EM index that's moved from one that reflected that global growth, global trade, fixed asset investment, commodities-oriented driven economy, to one that's more about domestic consumption, middle-class consumption, which is more reflective of the global indices. And so just to give you a couple of specifics, you can see in the information technology sector, that's gone from a little over 10% to close to 20%, which is much more like what you would expect in a global index. You've seen the materials weighting fall during this period. At one point, it was actually close to 5% before we had a rebound over the last 18 months. You've seen the energy sector contribution also fall during this period. And then you've seen a rise in sectors like consumer discretionary. And I think these all reflect the changing dynamics and the changing opportunity set within EM that frankly is more attractive from an overall investment opportunity. And like I said earlier on, a lot of this has been driven by China in the early stages, but it's being handed off to other parts of Asia, in this next phase. So with that, I'll stop there and open it up for questions.
Great, thanks, Charlie. It's kind of a good primer. I think when we look at what's gone on with China and some of the tailwinds you were speaking of, what are some of the risks? What do we see getting in the way of, whether it's China or other developing nations within Asia? What sort of gets in the way of that tailwind? Is it internal regulatory issues, or kind of their own governments getting in the way? Intentional slowdowns, maybe? What are some things that you see getting in the way?
Yeah, I mean, I think I'll kind of answer that. I'll answer that two ways. I mean, one is the most obvious. China has been a challenging place to invest really for the last 2 years. There's been uncertainty around the regulatory environment, specifically for large private sector companies. There's been uncertainty around foreign policy and primarily with respect to the U.S. and how that might impact domestic industries. On the flip side of that, I would say that China is pretty transparent about where they want to go with things. And so they made it pretty clear that they didn't want to have any large private companies that were more important than the CCP, the Chinese Communist Party. And so they really, kind of enforced that by chopping some of the tall poppies down, if you will. The second side, the other side of that is that they also said, we do want to invest behind alternative energy. We want to invest behind semiconductors, and we want to have a software industry, and we want to have more focus on automation. And you've seen a lot of capital flow into those areas, and it's been very clear that that was a good place to invest. So I would say, reading the policy tea leaves is always a challenge in China. It's been particularly more challenging in the recent past. I would say in general, if you listen closely enough, they'll tell you exactly where they want you to allocate capital. And that's, I think the playbook for investing anywhere is understanding, what the government's ultimate goals are and being able to, get on the right side of the policy agenda through your investments. That's an important angle.
Maybe it gets too specific into investing, and just for my own interest, thinking like, do you have to be more of a strategic investor when we look at investing in Asia, or can you really take a buy and hold strategy?
Do I have, well,
I mean, obviously you have an opinion because you all are strategically allocating capital, but I think just in general as an investor, like, is it a place where you can park funds and wait it out and wake up in 2040 and feel good?
well, I think emerging markets are increasingly becoming that. That they're still volatile. They're still slightly more volatile than developed markets, although that's converged quite a bit. And I think a lot of it has to do with that index composition change. But really, what the way that we approach it is to try to say, who are the blue chips that if you were in 1980s in the U.S., which companies would you have bought then that will persist through the next 40 years and generally compound at an attractive rate over that entire period. And so that's what we're really focusing on, are companies that we feel confident, well, we call them strong businesses, that they have a dominant moat around them. And we do think this is a market, and I'm speaking about emerging markets in general, but is a market that should be approached as buy and hold, because it's very hard to time periods of outperformance and underperformance. And the amount of excess outperformance that you generated during the 2000s, when people were still skeptical because of the Asia crisis in the late 90s, was substantial, and it was the bulk of your performance for the last 2 decades. And then if you flip that over, the S&P underperformed during that whole decade, but then outperformed the next decade. And so these things can be lumpy, and I think that they often tend to happen when you're not necessarily expecting it, and it also is out of phase with developed market performance. So they're pretty good portfolio diversification opportunities as well.
So when we think about China and Asia and its role in the emerging markets, how much when we look at these trends are the other kind of BRIC nations contributing, right? Is it Brazil and Russia, or is it really focused more in the kind of the Asian region?
Yeah, I mean, most of the trends that I described on the demographic side, the middle class growth, that's Asia. That's probably 60-70% Asia, maybe even more. Africa is it's not a part of the universe. Latin American countries are either smaller population sizes, or they have fairly large middle class consumer bases already. Like if you look at Chile, for example, that's a fairly wealthy country. Like I mentioned, or they're smaller countries. And so it's really, it's a couple 100 million people in India, it's a couple 100 million people in China, it's a couple 100 million people in Indonesia and across Southeast Asia. That's where this driver is really coming from. Russia is no longer in the universe, but the demographics in Russia were pretty bad. And so I would say India is really the standout, in my opinion, for the next decade. They have a lot of things going for it, in the sense that they've instituted multiple reforms over the last couple of years, targeting different parts of the economy. One was trying to get rid of corruption through the demonetization process. So they took large cash bills out of circulation. That also enhanced tax collection, which then has enabled them to invest in other parts of their economy, particularly the railway infrastructure, which is helping to unlock productivity. And now everybody needs another place to shift their manufacturing facilities from, because they want to move out of China and they want to capture other parts of Asia that have low-cost labor bases. So India is a good choice because they have a large English-speaking population that's fairly well educated. So there's a lot of tailwinds for India that I think are really coming into motion now, and could be a real important market for the next decade.
Great. And then, so if we're looking at India and China, what about how the more developed nations or developed regions in Asia sort of play a role, whether it's South Korea, um, Japan? I think Taiwan's probably its own story there, but um, particularly South Korea and Japan.
Yeah. So I think Korea's an interesting choice or an interesting market because they play two roles. One is they are investing in other markets because they need access to a lower cost labor base in some cases. So Samsung shifting mobile phone manufacturing to India as an example. Um, but Korea also has become a very tied to EM trade because they export a lot of their goods used to go to the US and other developed markets, but now much of their trade goes to China and other emerging markets. And so they need the consumers and the labor from emerging markets to really to drive kind of the Korea business model forward. Japan, I would say, is more of a country that exports capital, so they want to fund investments in these countries because they don't have the other industries to fall back on. They're in some respects they're exporting still, but they're no longer a leader in many industries, but they still have a lot of savings that for investment. So I think that what you've seen quite frequently around the Asian region is a Japanese companies, conglomerates making investments in local manufacturing. In many cases, they're not even the operating partner within that, but they're providing capital.
Great. So what about, I mean, I guess when we look at the group joining us today, obviously a big topic on everyone's mind is the recent meetings between Russia and China. Do you have any just thoughts on what that means sort of in the economies, or sort of pushing further sanctions against China? It's
Yeah.
kind of hard to unwrap, I think. So I was just curious what your thoughts were there.
Well, I thought it was very interesting that China was able to broker, I wouldn't say a peace deal, but at least a diplomatic um, resolution to the relationship between Saudi and Iran, and they did that just before the trip to Russia. And so my hope had been that they would come up with some way to resolve the Ukrainian conflict through the negotiation with Russia, and that would be good for China to raise their role on the global stage as well. I think a big part, China wants everyone else to view them as a member of that global elite, if you will, and that would have been a good step forward, I think, for them to broker two important peace deals. Unfortunately, it didn't turn out that way. But the reality is China, even though they're less reliant on exports and infrastructure, is they still need a lot of commodities. So they still need a lot of oil. They still need a lot of natural gas. They're trying to reduce their dependence on coal. And Russia now needs a new home for a lot of their commodities. So I would say they're coexisting because they need each other right now. But I would also say that I think China learned a valuable lesson from the Russia-Ukraine crisis, because I think they learned that things are not as easy as they might appear, when you're running your military simulations to take over another country. And it's very harmful to your economy to have global sanctions placed on your country. And so, if China's ultimate goal is to maintain full employment and economic growth and income growth, and that's their path to stabilization or to maintaining a stable society, invading Taiwan and having a series of global sanctions and fighting a war that may not go as smoothly as you think would really be a very challenging situation for the government. And so I think that's probably force them to take a step back if they did have intentions of making a move on Taiwan in the near future.
It's interesting because a lot of clients or a lot of people we talk to feel like that's inevitable at some point in the future, is that, you know, some type of action by China to kind of further control in Taiwan is just going to happen.
Yeah.
And maybe it's happening on a small scale, but certainly not militaristically yet.
Well, you know, I mean, if you're traveling in Taiwan, it's not as prevalent as it in the media as it is here. You know, I think it's the Chinese Taiwan relationship has been under development for 40, 50 years, and it's something that people have learned to live with. There is always this tension between China and Taiwan. It's not exactly sure how it's going to play out. I still have relatives in China. I may still have business operations in China. Taiwan's main trade partner in most years is China. So there's a sort of a cozy, not so cozy relationship between the two. And I think the two sides are more comfortable with it maybe than the rest of the world might be, especially the US. I think the other side of it is China views Taiwan as China, and they view the citizens of Taiwan as Chinese. And I said, so it would not look great for them to go in and have an aggressive military attack that led to a lot of casualties. I don't think that would achieve their internal goal. I think that what they're hoping for is some more of a diplomatic resolution to this that could lead to something like, you know, what we've seen in Hong Kong, where you have two systems, one China, or, you know, where Taiwan can be absorbed slowly without being disrupted to you know, the way that they do business today.
Great, thank you. Curious, I don't know how much you look at it from the US perspective, but just curious how, you know, when we look at sanctions against China and, you know, sort of when we get into that kind of tit for tat back and forth with sanctions, is, you know, how detrimental is it to other countries as we place those sanctions on China, both for China or maybe for those countries that are trying to, you know, force certain things upon China?
Yeah, you know, so speaking about China specifically, the contribution to GDP growth from net exports has been near zero for about the last 7 years. So even exports as a percentage of the total economy are still a reasonably large size. I want to say they're, you know, still 20-25%, but
Of the Chinese economy, is that?
But it's not growing. And so it's not contributing to growth. And in fact, it's been declining. And so in some years, it's actually a headwind for growth. And that predates the US trade sanctions. The biggest issue for them is that they have a labor base that's seen their wages go up double digits for the last 20 years. And so they're no longer have that labor arbitrage opportunity that they did in the past. And so that's why even before the pandemic and before the trade war, we started to see our Chinese holdings moving their manufacturing overseas, like to Cambodia and Vietnam. And so that's been less important. Trade, you know, as an overall part of the economy is becoming less and less important for China. And then,
so is that where sorry to interrupt, I was just wondering, is that where we're going to see it continue? Is it going to move more into, was that Southeast Asia, is that right? Or
Southeast Asia and also India. So, you know, I think that's a big part. India wants to be that. Indonesia would like to be the destination for a lot of this manufacturing, which, you know, is going to be a nice tailwind. You're seeing it in Mexico as well. You know, we own a bank in northern Mexico, and they, you know, they're seeing their loans to small, medium businesses really take off. And that's an area where it's just a real bright spot for them. If you look at the industrial REITs in Mexico, their occupancy is basically 100%, and they can't build things fast enough. So it is moving, and it's creating new opportunities. But I would say it's not really a headwind for China, and it's not at this point a significant new tailwind for a lot of these other countries because this has sort of been in motion before. And it takes time to reorganize supply chains. It's not like you turn off one tap and then turn on the other, and it doesn't quite work that way.
Great. Do we see anything with changing with the, I guess, the dollar hegemony as we look at, Russia looking to China for some, transactional purposes? Is there anything there, or is it really just sort of a temporary, occurrence with an agreement between the two of them? Or
Well, I would say that there's many countries around the world that wouldn't mind seeing less dependence on the dollar, and that could be for a variety of reasons. And I think, one is I think people are appreciating how much of an advantage that we have from a cost of capital perspective when the rest of the world is always clamoring for dollars, and what that allows us to do with interest rates, probably get away with in terms of interest rates here in the U.S. I think the recent period has showed that that's something that maybe it isn't something that that it's an unfair advantage, I guess. I would say commodity exporting countries also don't like the fact that that there's a lot of mismatches in the way that their model works, and so periods of dollar strength, that's fine. Especially if your local currency is weakening, but you would like to hedge yourself by being able to transact in other currencies. And I think from China's perspective, it's a strategic initiative to try to diversify away from the dollar, because they know they are actually personally responsible for driving down our cost of capital here because they've been buying so many treasuries for so long. But it's less required, now when you're not exporting to dollar-based economies as frequently as they did, and global trade slowed, that also, makes demand for them to buy, dollars less important. So I think there's some natural shifts in the global economy, and I also think that there's strategic reasons that countries want to move away from the dollar. And I would say it's slowly happening, but it's very hard. I mean, our global financial system is really based on dollars, euros, and yens.
great. Let me just see what other questions were coming up here. What about, I guess, curious, when do we see these economies, say like a China, when do they become not emerging anymore? Like when is that shift, right? Because we've seen that immense growth in the middle class, a real developed, what appears to be a pretty developed economy. When do we start looking at them as such?
Yeah, I mean, typically when people ask this question, they're also sort of thinking about Korea as well, South Korea, and just Taiwan. Because if you're in the major cities in South Korea and Taiwan, or on the East Coast of China, you feel like you're in a developed market. They have, in many cases, nicer airports and hotels and roadways than we do here. Especially in Santa Fe.
I did a semester of business school in Shanghai, and so I got to experience, taking their very developed subway system and really nice airport. It's, pretty advanced.
But if you move outside of those major cities, the countryside looks very different. And so I think, the challenge with per capita GDP numbers is that they don't tell the whole story. They probably tell the story for the most part for South Korea, but maybe not completely for Taiwan, and definitely not for China. And so I think Korea and Taiwan are much closer to being able to move up to a developed market status than China would be, because there really is, several hundred million people in China that are still moving quite quickly up the development curve, and I would say they still are appropriately classified as an emerging economy.
Great. Yeah, I was just curious, like, cause you think of them being such a major player in the world and everything that goes on, and then it's like, oh, well, when do they stop being what we, think of as emerging or developing? But what about the housing markets or the real estate markets in Asia? Is that somewhere, is it more of a risk? Is it investable?
Yeah. So what I would say is that it's really country by country basis. Every country has their own dynamics. Um, Funding can be a challenge in terms of how do I get a mortgage. Some countries really only have very short term mortgages, so you basically have to be able to buy the house in cash for the most part. Um, some countries don't have available supply, so it's just very hard to find a new home. If you look in China, I think that there's a shift going in that property market right now where, historically people have had the bulk of their wealth tied up in property market with some savings and traditional deposit accounts. And one of the things that we're seeing shift there, and we have an investment in an online broker there, is that we're seeing people move money out of the property market because the returns there haven't been great for some time, and move them into other things like life insurance and mutual funds and single stocks and fixed income securities. If you look at India, India's housing market stagnated for the last 10 years, and it's really starting to take off right now. And
Is
the
there, is,
driver,
is there a reason that it's stagnated?
yeah, it's affordability. So prices ran up really high in the 2007, 8, 9 period. And when emerging markets were doing great, incomes were growing quite quickly, inflation was a little high. And so that kind of also fed into it. And affordability just got ahead of itself. And it's taken basically a decade for prices to go sideways. The developers stopped building, a lot of developers went out of business. And then there was a bit of a credit crunch for the housing developer market. And so that also cut supply. And then there's been a lot of consolidation. And so today the supply demand balance has gotten a lot better, and affordability has gotten a lot better because incomes have been growing for 10 or 15% for the last decade. So and now India's housing market's starting to take off again, and that's something that people are expecting to do really well for several years. And then if you take a market like Saudi Arabia, you've had a government imposed target of increasing home ownership nearly to, I believe it's 65% of the population by 2026. And so you're seeing a really rapid growth. Banks have been focusing exclusively or more exclusively on that market. You're seeing mortgages grow 30-40% a year for the last couple of years, and home ownership's really taking off. Well, there's, as an asset class, that's not something that we can really invest in other than a developer here and there. Saudi Arabia doesn't have developers, but they have banks that are lending into that market, so that there's other ways to invest in that opportunity.
Great, thanks. Maybe as we sort of get closer to the end here, we'll have a little fun, but so something Charlie didn't tell us when he introduced himself is that in his bio, it says you have a PhD in geophysics.
Yes.
What type of perspectives can you get on the emerging markets with a PhD in geophysics? Is there like a special insight you can gain from that?
So my background, I was actually an earthquake seismologist. So you could say that emerging markets are often on shaky ground. So, no, but seriously, no, I think, I was very fortunate to work at a shop when I first started in the business in Denver that liked to train people from different backgrounds. And my time as an academic really trained me how to think about complex issues and distill them into the most important components, and then be able to talk about them or share those ideas with other people. And I know those are all skills that many people take for granted, but I do think that they're very important, especially in this industry. And so I was very thankful to have that training before. And then, there was a little bit of domain expertise that I was able to bring over. I covered oil and gas when I first got into the business, and that was something that I was able to leverage my time as a geologist. And I worked at Schlumberger for a little while, and I was able to make that transition.
Yeah. So do you ever look at like a emerging market commodity stock and say like wow,
Yes.
like really drill down in and get a
Yeah.
have
So
some special insight?
one of my first investigations was on the Brazilian, the largest Brazilian energy company. And it was right before they found all of the oil and the pre-salt in the 2007 period. So I went down to Brazil late 2006, and yeah, really kind of was able to get deep into the geology with the team there, and we were able to make an investment then. So it worked out well for us.
Great, thanks. Yeah, sorry, I left it out at the beginning, and I was really hoping to find a chance to get us back there. So maybe it's just a way to wrap up. I think generally you would still think there's pretty good opportunity in Asia, particularly as a long-term investor. And I'd say, I mean, is there any way? I may have another question. Oh, it's a question. Yeah, I mean, there's a good question. How do we think about in emerging markets in China? How do we think about, especially right with your background, is thinking like, how do we take in environmental concerns when investing in emerging markets?
So, ESG has been an important part of what we do in our strategy for some time. Initially, it was really thinking about the risks, how really governance risks could create challenges for us. But what we realized is that companies that were thoughtful about governance, thoughtful about social issues, like having a diversified workforce or paying people an appropriate wage, or thought about their impact on the environment, tended to be better companies. And so really helped us to find better investment opportunities. And so we've really kind of flipped it on its head. And so, when we look at companies in any country, we want to think about issues related to environmental or social or governance as things that might introduce new sources of risk to that investment opportunity. And so we're always looking at those factors, regardless of the investment, regardless of the country. And if maybe a company does have, or they're more prone to have greenhouse gas emissions, or be energy intensive, or be water intensive, that's perhaps a longer term threat to their business model. And so we want to be conscious of it. And it doesn't mean we don't make the investment. We own energy companies, we own electricity companies, but we want to know how they're thinking about future proofing their business if they don't have access to XYZ, input to their business. And that's how we think about it. And so really it's not rocket science. It's really just thinking about how is your business, going to navigate a period where there's less of this thing available that helps you do your job.
Great. Well, I think with that, maybe that's a good place we can kind of close it out. I don't know if you have any last thoughts, but I think emerging and the Asian economies do present really interesting options, to look at when we try to think about diversifying beyond the U.S. and kind of our own kind of bubble here. And it's a complex topic outside, so it's really helpful to have you here and provide your insight.
Yeah, thank you. Yeah, no, I guess the last thing I would just say is that I do think emerging markets have been set up to take off for some time. And unfortunately, you've had things like COVID and the US-China trade war and China's move to the zero COVID policy, delaying that takeoff. But I think that if we're in a period for slower US and developed market growth, it really could be a good setup for emerging markets during that time.
Great. Well, thanks again. And anyone interested in learning more about this topic, please feel free to reach out to any of us here at the Raccoon Group, and stay tuned for our future editions of A Trip Around the World. And thanks again, Charlie. We appreciate it.